Good afternoon, everyone, and welcome to the October 2023 edition of Epic Insight. This is Joe Corona. I'm the Director of Sales and Strategic Partnerships at Epic Retirement Plan Services, and I will be your host for today's call. With today's Epic Insight, we're going to conclude our two-part series on cash balance plans. As you may remember, in the September edition of Epic Insight, we learned about the market potential and the fundamentals of offering cash balance plans. For the October edition of Epic Insight, we will be focusing on the investment strategies for cash balance assets. With that in mind, we are excited to have joining us Ross Brown and Eric Souders from Payden Rygel. In a moment, I'll hand over the microphone to Ross to say a few words and to introduce our presenter for today's session. Ross has been a retirement industry sales, operations, and relationship management executive for more than 25 years. Currently, he serves as Vice President of National Accounts and Head of DCIO for Payden Rygel, one of the largest privately owned global investment advisors. Your line will be muted throughout the call, but if you have any questions you'd like addressed at the end of the session, please enter them in the webinar control panel, and we will address them at the end. With that, I would like to turn it over to Ross.
Joe, thank you for the great introduction. Welcome everyone to our webinar, which will focus on the Payden Managed Income Fund for cash balance plans. As Joe mentioned, my name is Ross Brown. I lead both our DCIO and retirement business here at Payden. I'm pleased to have my colleague Eric Souders, who is Lead Strategist for the Payden Managed Income Fund, share his insights on our fund, which was designed specifically for cash balance plans. And before I turn it over to Eric, I want to just take a brief moment and share an overview of Payden for those who might not be familiar with us. Payden is currently celebrating our 40th year as a leading private investment manager focused on fixed income and enhanced cash management solutions. With offices in LA, Boston, Milan, and London, our investment approach is all run in-house with no outside advisors. Our culture is extremely collaborative and collegial through our One Governance Center, and today we manage close to $145 billion of assets through two key business lines. First is our institutional separately managed accounts, where Payden got its start and services 360 institutional clients around the world. Second is our portfolio of fixed income mutual funds that focuses on numerous strategies, both domestic and internationally. Our managed income fund is available on the Epic Retirement platform and all major custodians they trade through, offering 4 different share classes based on cost and compensation needs. After our webinar, feel free to reach out to me at rbrown@payden.com or your Epic Regional Retirement Consultant for more information. So with that brief overview, I'd like to introduce Eric Souders, who is a Director and Lead Strategist on the Global Unconstrained Fixed Income team, with a focus on absolute return and multi-asset credit solutions. In this capacity, he's responsible for oversight of idea generation, strategy implementation, and risk management. Eric is also a senior member of the ESG committee. And prior to joining Payden, Eric worked as a portfolio manager at Guggenheim Partners, focusing on multi-asset and structured product dedicated strategies. He also worked at BlackRock, serving as a lead portfolio manager within investment-grade corporate credit solutions. Eric's a member of the CFA Institute and CFA Society of Los Angeles, where he served as a member of the board and instructor in their fixed income review program. With that, I will turn it over to my colleague, Eric Souders.
Thank you, Ross. Thank you for the introduction, and thank you to everyone for being a part of the call today. We really appreciate the attendance and the interest in hearing Payden's story as it pertains to cash balance management. So I want to spend some time on the heritage of our cash balance offering. I think it ties well into the heritage of the firm here at Payden. I want to talk a little bit about the way the team is arranged, a bit about the process. I want to show you what the portfolio looks like today in terms of how we're positioned. I do have a variety of just macro pages at the end of the presentation to give a sense of what our outlook is with respect to markets today. I'm not going to spend a ton of time on those pages. I think that I'll kind of get to some of those themes throughout the positioning and throughout the discussion, but I will leave those pages there. Of course, if there are any questions as it pertains to markets or macro, happy to answer questions toward the end of the call, or of course follow up as interest may exist after. So the heritage of Payden, I think Ross did a nice job really summarizing who we are as a firm. Going back 40 years, Payden is really a pioneer in the low duration corporate cash management space. Actually, Joe and Payden founded the firm really identifying an area of unfilled need where she felt like corporate cash wasn't being sufficiently managed. And so over the course of the last 40 years, the firm has really grown from that foundation of corporate cash focus, which really tends to be focused on balance sheet management, minimizing drawdown, minimizing volatility, and then just really optimizing the return that's earned on cash. And so the firm has grown from that as the starting point and the ballast to now offer dedicated strategies really across the gamut of fixed income, including investment grade and high yield corporate credit, bank loans, emerging market debt. Emerging market debt's a big part of what we do here at Payden. It's been a part of Payden for about 25 years now, since the late 90s, and then of course securitized credit. And so thinking about the heritage of the firm and our cash balance offering, it really started with a client who was looking for a couple of very simple things. One was preservation of capital, mitigation of drawdown, really just the protection that should exist in adverse environments when you own bonds. The second thing was a reasonable return above cash over time. And now obviously cash balance plans are geared toward beating a funding rate, which happens to be 30-year treasury rate. I'll talk a little bit about that in a moment, but I think that those two objectives that client was looking for really resonated to us as a firm, because we felt like that first objective, preservation of capital, managing drawdowns, really mitigating volatility in financial markets during adverse times, we feel like that was really kind of the genesis of the firm, something that we were already doing for 25 years. And by the way, this client came to us at the end of 2008. And so at that point, the firm had been around for over 2 decades, really focusing on that first objective. The second objective, some reasonable return above cash over time. We looked at our dedicated strategies across corporates, emerging market debt, and securitized credit. We looked at our ability to manage those strategies versus benchmarks. We looked at the shape of yield curves, historically being upward sloping, especially at the front end of the yield curve, that kind of 0 to 5 year part of the maturity spectrum. We thought about what's the typical credit risk premium over time. What are you being paid to own credit? And so we felt like a return of cash plus 2 to 3% over medium-term periods of time made a lot of sense. And so when you kind of wrap that into a cash balance plan and trying to beat a funding rate, where obviously you've got a pretty long durated asset there with respect to the funding rate, 30-year treasury, we feel like our offering is a very effective way to deliver a consistent and very stable return, very steady yield relative to that funding rate, while not incurring the amount of volatility that you'd obviously incur if you owned a 30-year treasury, or even a more traditional balanced fund, or a more traditional fixed income offering like a core bond mandate. So the right-hand side of this page, it begins to kind of unpack the things that I'm talking about, which is where does this managed income strategy from a cash balance standpoint, where do we think that fits in the continuum of your typical cash balance offerings? We think it kind of fits right in the center of that continuum, which is between traditional fixed income on the bottom right, where you've got more interest rate duration, typically a 6 or 7 year duration. The duration profile of our cash balance strategy is typically 1.5 to 2, so relatively insensitive with respect to interest rate risk. Traditional fixed income also has lower yield and less diversification, because you're really subjected to managing versus the Barclays aggregate benchmark, which has a material amount of exposure to treasuries and agency mortgage-backed securities, where yields tend to be lower. And then obviously you've got less diversification, given you're not unlocking opportunities across all parts of the fixed income market. And so when we kind of canvas where we participate on the left-hand side of this page, in that key asset class section, we're trying to incorporate all parts of the bond market. This is going to be public fixed income, so it's going to be liquid, publicly traded securities. We're not using leverage. As I'd mentioned, benchmark agnostic. And then some equity utilization, more I'd say tactical utilization of equities, and that's where on that continuum on the right-hand side, we kind of sit above the traditional fixed income offering, but below your traditional 60-40 offering, where you're going to see, a pretty steady mix of both equities and fixed income. Now, obviously, the last couple of years has not worked well really for either barbell of this continuum on the right-hand side. So you've had a lot of volatility in the bond market. Equities have actually held up pretty well. Tough year last year, but pretty good recovery this year. But nevertheless, traditional fixed income has struggled given that long duration profile, lack of diversification. And then your typical balanced funds, volatility that there has been far higher, just given the heightened volatility that we've seen in the bond market. So we think that this strategy, and you'll see this on the performance page, you'll see it with respect to the characteristics of it. Again, we think it fits very nicely in between a traditional balance mandate and a traditional fixed income portfolio. So the punchline for us, the bottom left here of this page, and then I'll move on. The benefits: you're going to get high yield like returns with lower volatility. You're going to get more dynamic asset allocation. So we think we do a pretty good job at rotating the portfolio when the market gives us that opportunity. There's not a lot of turnover, but we do think that when the market gives you some sort of price performance, it definitely warrants moving capital around. And then, as I'd already mentioned, an attractive risk-adjusted option versus equities. And I think Ross mentioned this a bit, but the format here is a 40 Act fund. And obviously we have a variety of different separate managed accounts where we're happy to partner with people and customize. Okay, so let's move on to the team. So the way the team is structured, I think works really, really well for this portfolio. Our strategy team is in the middle of this fried egg page, if you will. It's myself, Nigel Jenkins, and Brian Matthews are the 3 senior PMs. We've got 4 other people on the team to help support the effort. What we're doing at Payden is, I think, really ties into the collaborative nature that Ross described. We're partnering with all of the subject matter experts across the organization. So we're relying on the credit research and the best ideas, the best themes, really across various asset classes that kind of surround us in that core nucleus. So you can see, left-hand side, ABS and CLOs, CMBS, RMBS, all the way through global rates and FX toward kind of the 1 o'clock position on that circle. This is really led by a lot of the macro observations and guidance from our investment policy committee there at the top of the page. Brian Matthews and Nigel Jenkins on our team are on that committee. And then the global economics team in the top left portion of the circle. They really help driving more of the micro themes, I'd say, things like the consumer, things like commodity prices, things like housing. So it's very much a team effort. We're relying on the good work and the good ideas and research that's conducted across all the asset classes around us. And we're trying to put those ideas into a diversified portfolio, really of best ideas. And I think one thing that's really important in terms of the way that we manage the portfolio, we're not giving pieces of the portfolio to each of these asset classes. So we're not sleeving out parts of the portfolio. And the reason that we're not doing that actually ties into some of the benchmark comments that I made earlier. So let's say, for example, we give 10% of the portfolio to emerging markets debt because the firm views emerging markets debt in a favorable manner today. The emerging markets debt team is managing versus their own benchmark. That benchmark is going to have exposures to different regions, different countries, different ratings buckets that they have to own. If they don't own some of those exposures, they'll have too much tracking error versus their benchmark. So they're literally forced to own certain exposures. Our strategy, on the other hand, our starting point is cash. We don't have a benchmark. We don't have to own anything theoretically. Now, we're going to tend to own credit, but we're not forced to own benchmark-facing themes. And we think that when we sleeve out the risk to these various dedicated sectors, we think that as hard as they might try, they're still importing benchmark-oriented ideas into a strategy that doesn't have a benchmark. So we think that's very important separation of church and state, if you will, between what our team thinks is appropriate in a multi-asset context with no benchmark versus what a sector-dedicated team might think is appropriate for their specific strategy that has a benchmark. So I think that's a big differentiator in terms of the way that we manage the portfolios versus some of our peers, and that certainly served us well during a period of time like COVID, where you had to really know everything that you had in the portfolio, re-underwrite it multiple times. So that's, I think, a very distinct feature with respect to the way that we operate day to day. The strategy components, this is really just kind of hitting on the process here. Very simple process, simple by design, and it's remained pretty steady in terms of the approach the last 15 years. So just making some adjustments along the way, obviously lessons learned during various market environments going back to the end of 2008. But nevertheless, deliberately simple by design. You've got a couple hundred positions in the portfolio. That's going to mainly sit in that core income part of the pyramid here. That's going to drive 80 to 90% of the returns. So again, we're really relying on the good credit work and the research that's done from a bottom-up standpoint by all the sector teams that help support the strategy. That portfolio is going to be global in scope, multi-asset, multi-currency. As a base case, we do hedge currency risk back to the US dollar as a starting point. And so any currency exposure would actually sit in that tactical trading part of this pyramid. So that's the second piece there as you kind of move up. The tactical positions are going to be what it says here: rates, FX, and spread product. This is meant to be complementary and just additive to performance, not meant to drive returns over time. And you'll see that if you looked at attribution again, thinking about that core income piece, 80 to 90%, tactical trading is about 10 to 20% of the remaining performance. We're looking for opportunities in each of these areas, rates, FX, and spread product, where we think we've got a good asymmetric profile, something that we can take advantage of. We have strict risk budgeting in this tactical bucket, so no position can lose more than 5 basis points at the portfolio level. Otherwise, it's closed and we move on. We don't want our losers to dominate portfolio performance and the good work that we're doing in the core income part of the portfolio. The final piece is hedges. You can really replace the word hedges with insurance. These hedges are really designed to provide protection to the portfolio. We are buying, at the end of the day, we are buying credit bonds. We do own some degree of interest rate duration. So we want to look for cheap forms of insurance to help protect those two big risks, interest rate risk and credit risk in the portfolio during adverse environments. So this can be things like out of the money options on things like the S&P 500, for example, where you can buy reasonably cheap forms of protection and help smooth portfolio returns and really dampen your drawdown over time. So that's the process in a nutshell. You've got a core income piece, global bonds, primarily for kind of 5 to 7 years and in with respect to duration, so pretty short duration. It's global in nature, relying on the good credit work that we do is in partnership with all the desks here at Payden. A little bit of tactical trading on the top on top of that, and then you got some hedges as the final piece of the pyramid here to help smooth returns over time. Okay, so I'm not going to go through this whole page, but we'll certainly leave it with you all. I think it does a nice job at illustrating a few things. One, where we participate across the fixed income markets. So you can see a variety of different sectors. Now, the securitized part of the market, it does play an important role here in this strategy. It tends to be an acronym alphabet soup to some degree. So we're happy to follow up and give insights into each of these parts of the market. I will say that the securitized market, although it was arguably the epicenter of the financial crisis in 2008, that market is far different today relative to where it was 15 years ago. You've got much more transparency around data and information. You've got much better alignment of interest between equity and sponsors and bondholders. You've got much more structural protection in those asset classes. You've got much more diversification. And there's a lot more global eyes on it. So liquidity has gotten much better. So that's a short way of saying that we do find a lot of value in securitized credit. You've got a variety of different asset classes, from consumer and commercial ABS to commercial real estate, residential real estate, and then just other parts of the market that are actually new. So an area like SFR here at the bottom of this page, single family rental, brand new part of the market. And you can see that in the middle of the page here, the size of these asset classes in 2012 and the size of them today. So pretty nice growth across most of them, including, again, brand new areas in securitized credit. The right 3 columns, I won't go through those too much. It's, I think, just a nice way of illustrating that we are participating really at all parts of the rating spectrum. And again, securitized is a great area where you can really pick your spot in the capital stack. You might like a AAA part of a particular deal. You might not like the BBB part of that deal. So it offers good flexibility and then a very nice range of yields there. So we'll leave this page with everyone. And if there are questions on this, happy to follow up. Okay, so I'm going to spend a couple minutes on just the macro scenarios that we see in front of us, and I'm going to tie that into portfolio positioning. and then I'll end with performance and then open it up for any questions. So I think as portfolio managers and really as a strategy team here at Payden, the two questions that we're always asking ourselves is, what's our base case with respect to the economic trajectory the next 3 to 6 months, and what's priced into the markets? I think a lot of focus is spent on what's the base case, and on this page you've got four different scenarios here on the left-hand side: no landing, soft landing, bumpy landing, and a hard landing. I don't think enough time is spent on what's priced, and so I'm going to talk a little bit about that now. So over the last 6 to 12 months, our view as a firm, particularly coming into the beginning of this year, has been that a recession in the US was unlikely the first 6, if not 12 months of 2023. So we were reasonably out of consensus in January of this year. We did not think a recession was likely in the US for at least the first half, if not the entirety of 2023. Now, the banking episode in March called that into question a bit. Something finally broke, right? So the potential bumpy landing, if not hard landing, that the market was anticipating, that was called into question. That became more likely in that March and April timeframe. And what we've seen since then really is a tremendous recovery in terms of just resiliency in the banking sector. I think that the Fed and just global central banks, generally speaking, they know the playbook. They've used it before with respect to a banking crisis, a banking episode. So bank balance sheets were largely shored up. Capital was provided, and largely that situation was a false flag, just in terms of broad market macro. And so, kind of entering the May and June time period, our team felt like there was a clear recovery in certain parts of the market. That included the labor market, which had kind of weakened after that March and April timeframe, but was then strengthening in the May, June, July time period. We're also seeing earnings. Earnings were quite strong, especially relative to expectations. Growth in the U.S. has beat expectations for 4 or 5 quarters in a row, so the market's been too bearish there. And then, of course, consumption. Consumption in the U.S. drives the economy, and so the tremendous amount of fiscal accommodation the last 2 or 3 years has really reinforced household balance sheets, which, by the way, had been delevering for about 15 years coming into the COVID time period. So big shot in the arm for the consumer. The labor market steady, if not improving, and the result was accelerating growth, which was quite surprising. So we felt like putting that kind of pieces of the puzzle together, and then looking at what was priced in the market. What was priced? Well, equities had rallied about 15% in the U.S. The U.S. dollar at that point in time was about 10 to 15% weaker versus the prior year. Oil prices had risen, but were expected to decline 10 or 15% over the next 12 months. Credit spreads across corporate bonds, emerging market bonds, really all parts of the credit spread part of the bond market were at post-COVID tights. All the while, the market was expecting the Fed to cut 4 or 5 times over the next 12 months. And this is, by the way, while inflation was running well above the target rate. So this to us felt like a soft landing was priced. So our base case was a soft landing, and you can see that in the 60% probability in that 5th column there in the middle of the page, but that was priced. So we felt like now we needed to turn our attention on what's not priced. So what was not priced was a hard landing or a no landing. The hard landing we felt like was very low probability, and we still feel that way. This is the some sort of systemic shock out of left field that you really can't predict, and it's very, very difficult to position for. So that, in our eyes, is very low probability at this point in time. The no landing is much higher probability at 20% there on the top. And so we felt like the market was not properly positioned for an acceleration of growth. So what would that look like? It would look like unemployment remaining low. And obviously we had a jobs number a week or so ago, very strong. We had inflation last week. That report was better than expected in terms of inflation being higher than anticipated. So elevated inflation relative to target, and in fact, by some measures, accelerating inflation. And the result would be higher interest rates, lower equities, stronger US dollar, and in a very strange way, it's the no landing from our perspective that might lead to the hard landing. So that setup would look something like the interest rate cuts that are expected the next 12 to 18 months, those get priced out. Interest rates are then expected to remain higher for longer. That puts pressure on risk assets, especially something like the equity market, where cumulative earnings growth is expected to be something like 25% the next 2 years. We think that's way too high at this point of the cycle. So we feel like risk assets are vulnerable. So as a result, the portfolio today has less exposure to high yield, more exposure to higher quality assets. So I'm going to leave this page here for now. There's a lot to unpack on it, but I think the bottom line for us is, again, we're always trying to marry what's our base case with respect to markets, what's priced, what's not priced, and how can we position around that. So when we look at positioning today, kind of try and tie this into something that we think is now occurring with respect to just regime change. The last 10 to 15 years has largely been reach for yield, right? Move out the maturity spectrum, move down the credit quality spectrum, move into less liquid assets, right? Move into private markets, move away from public fixed income. We don't think you need to do that anymore. We think that now effectively you can do the opposite, right? You can shorten your duration profile. The yield curve in the US is very inverted, less so than it was a month ago, but still very inverted. You can move up the credit quality spectrum, so you can own higher quality assets where yields are elevated, 6-7% for investment grade corporates. Looks pretty good, especially when you look at that versus the earnings yield of the S&P 500. And then you can move into more liquid parts of the financial market complex. Broadly speaking, you don't need to reach for that illiquidity premium that you needed to the last 10 to 15 years. And so as a result, in our portfolio, our interest rate duration today is pretty low, 1.5 years. It's normally between kind of 1.5 and 2.5. So on the lower end of that spectrum, we do think that that the Fed is close to being done with their hiking cycle, but we think that the bond market is going to continue to put pressure on the bet that the Fed is making effectively, and we think that that's manifesting itself in the long end of the yield curve. And what is that bet? That bet is that inflation will come down. The Fed is pausing before inflation is at target, not just at target, anywhere near target. So the bond market is signaling that they think that the Fed is still behind the curve, and that's why you're seeing bond yields sell off, especially in the long end. So we're keeping duration pretty short. We've got a nice yield, so you can see the SEC yield there is about 5%. If you looked at the yield to maturity of the portfolio today, it's about 8%. So obviously our yield today is running well north of where the 30-year crediting rate is. But I think over time, the goal is to try and beat that crediting rate by a small margin when we think that's available, knowing that there's going to be some years where we give a little bit back versus that crediting rate, which I'll get to on the next page, which is performance. The right-hand part of this page just shows the distribution of our exposure. Again, very good diversification. We want to see diverse returns over time in terms of where returns are coming from, and we have seen that. But a pretty healthy mix between corporate bonds, securitized credit, and then emerging market debt in the bottom right, and then a nice amount of just pure government bonds and cash at 12% there at the bottom. Again, as we think that liquidity plays a much more interesting role today than it has the last 5 to 10 years, given you're actually earning something on cash, and cash provides flexibility from a portfolio management standpoint when opportunities arise. There's a couple pages here in terms of how we've managed duration. Again, it is an actively managed portfolio. I'm going to leave this here. It's just to say that duration was lower about a year and a half ago. We brought that down throughout 2022. That's on the left-hand part of this page, and then that's now oscillated the last year or so. Yield curve positioning is on the right. We've been much more defensive in the long end of the curve, actually net short duration there. So try and take a bit of advantage there in the long end, as we felt like that's been vulnerable, and that's worked out quite well lately. This page shows credit spread positioning. I'm not going to cover it. I'll just go right to returns, just in the interest of time here. So going back since the end of 2008, really kind of starting from the right-hand side of the table, moving all the way left, you can see just very, very steady and consistent returns. Obviously the bond market has had a very tough go the last 18 months. This fund last year, net of fees, was down around 4% in a year where the bond market was down, between 7 and 15%, depending upon what market-based proxy you're looking at. So very steady returns. And again, that's the name of the game. That's why we've designed this fund the way that we have, really trying to just effectively manage the best that we can around what the bond market is offering us, and doing that in a very consistent way. This year's been a good year, 4%, north of 4% there on the left-hand page. So a pretty nice bounce back from what was a very challenging bond market collectively last year. I'm going to leave it there. There are a lot of other macro outlook pages here at the end, but we'll go ahead and leave that with you guys and open it up for any questions. Thanks again.
Great. Thank you very much, Eric and Ross. Appreciate it. We'll now open the floor up to a few minutes of questions. So if you do have anything that you'd like to run by us, please enter it into the question panel below. One question that has come in is, in working with advisors, do you see them using this strategy as a standalone investment option for cash balance or as part of an overall larger portfolio?
So I'll be happy to take that one, Joe. Thank you for the question. I think it typically starts with the size of the plan and the comfort level that the financial advisor has when looking at putting together an investment menu for a cash balance plan. I don't like to say that the Payden Managed Income Fund is a one-size-fits-all solution. It can be used as a sole investment, but it can also complement other types of fixed income instruments that others feel is important, to obviously bring in. So it really depends, also on what is the interest credit rate that the plan is designating and what comfort level they have. So there's no mandate that says that you only have to use the Payden Managed Income Fund. We welcome other investments to complement it, where the advisor and or the actuary possibly see that a combined solution would meet the targeted interest credit rate.
One other question that came through is, do you see any potential changes to investment philosophy based on whether the plan is using a fixed interest crediting rate or if they're using a market rate of return for the plan?
So the fund itself was designed, really for a market performance-based structure, right? It is mark to market. So again, looking at how the plan is going to be set up with respect to the funding rate, I don't see the fund itself changing, that much. Eric can weigh in if he feels differently, but for the past 15 years, its performance has been very consistent, and I would say that kind of plays into based upon how they're kind of structuring that credit rate.
Yeah, I would just add that that just maybe zooming out and to say this strategy, not just the managed income piece of the broad effort here. We're managing assets for clients that are looking for cash plus, so from cash plus 1 out through cash plus 4. That's in both fund and separate managed account format. We're trying to manage assets for clients that are looking for more of a kind of a static return, something between 3 and 5%. Obviously, that sort of discussion and that outcome will have to be addressed when markets change. But I think it's just to say that what we think we do well here at Payden is customize, and the managed income fund here does try to acknowledge the crediting rate that we're managing against, but no, I don't think that the fabric of what we do, the process, the approach, the team, none of that would necessarily change given a change in the objective. I think it's just making adjustments as we have for 15 years.
All right, wonderful. Well, that covers all of the questions that came through today. So we'd like to thank again our presenters, Eric Souders and Ross Brown. And thank you all for joining us for this Epic Insight webinar. As a reminder, we will be sending out a copy of today's presentation as a follow-up. As always, we wish you safety and health as you support your family, colleagues, and clients. Please don't hesitate to contact us if there's anything that Epic Retirement Plan Services and Payden Rygel can do to support you and your efforts. We thank you, and we look forward to having you join us on an upcoming edition of Epic Insight.